What's up, guys? Welcome in. More Than Mortgage. Zach Jones, Chad Anderson. Holiday shopping is upon us.
Mm.
And first of all, let's just go ahead and preface this whole episode with it's okay if you don't buy Timmy the PS5 this year because the only way to buy it is to go put it on a credit card. All right. That I don't want to sound like a certain, prolific radio figurehead who happens to live in Nashville, but I do side with him on these types of topics where it's like, it is okay if they don't get the new iPhone 39 Pro Max X triple MI chip that'll do all the whatever. Those things are okay if your only method is to put it on a credit card. Now, for those of you who aren't going to listen to that, and for those of you who, honestly, because we're all Americans and we all do this to a certain extent, we already have credit card debt, or maybe because of the economics that have taken
Yeah.
place recently and
Right.
or the rate of inflation, maybe the only method of survival for a little bit has been credit card debt. So we're not here to cast judgment, point blame, but we are here to maybe try to steer you away from a bad decision or a bad habit, but also show you some ways to get bailed out of this. So we're going to give you three things around holiday shopping. This is just typical American habits, but we're going to talk about three ways that you can relieve yourself of some debt here around the holidays. So, Zach, anything to add before we jump into these three? I mean, I know it's one of those like it tugs at you, right? Because we all go for our kids' reaction or our spouse's reaction. Like that's what we really long for is that 30-second window of the reaction of the greatest day of their life because of something that they were given or something that made you feel good that you did for someone else. But sometimes that also puts us in a bad spot here and there.
Right. We've all got that, those drivers, whatever they are, for the ideal magical Christmas, and
Yeah.
I think it's a uniquely American thing. But I want to underscore maybe before we get into these bailouts, because they're really not solutions. These are kind of the bailout survival tips here on too high balance on your revolving debt. We probably are going to have a whole lot more people who have kind of inadvertently escalated those balances up over the course of the last 18 to 24 months just because of inflation, thinking, well, things are going to turn soon enough. And, kind of this, what I call magical thinking, that something is going to happen that's going to reverse the course and make things better. And I'll just put it on the credit card for now. And, whatever magical thing is going to happen will happen later and it'll all go away. And we know that Americans are in more credit card debt than we've ever been, or certainly in recent history. We've got more of that kind of debt. So,
1.2 trillion. Is that what we're up to?
it's just I don't even know. Those numbers they're not meaningful for me. It's meaningful when I look at my own situation, and when I look at other people's, when I'm looking at pre-qualifications for mortgages. I know that those balances are high, and I'm seeing a lot of people buying houses. They say, well, I'm not going to put the whole proceeds from the sale of my house down because I want to resolve this debt. I want to do some things. I'm going to move and shift some things around. And I'm personally having a lot more of those conversations with clients. So I know that people of all income levels have more debt than they want to have.
Yeah. Yeah. That's just the way we've been living, recently. And whether that is by decision or by force, because
Right.
things have just gotten more expensive with inflation. So, uh, again, sometimes it's bad decisions, sometimes it's market conditions beyond your control. And a lot of times, too, we have a lag in changing lifestyle based on market conditions. And that can put you behind. I'm guilty of it too. It's not like I'm sitting here in an ivory tower yelling at everybody about what everyone should be doing because I've been in credit card debt. I still have a little bit of credit card debt, but just some of those things you got to be understanding of and figure out a way to control or look for some safety nets, which is what we're going to talk about right now. So the first one, this is one that I don't think people realize is a true outlet. And it doesn't erase debt, but what it does is erase interest. And that is with a balance transfer. So, quick explanation, and I'll let Zach dig in a little deeper on it. But the surface level is if you have debt on a credit card, then another credit card company or bank may come to you or pop up in your email, or if you just Google it, you'll find some. And they'll say, hey, if you want to transfer all your debt, you can do that, move it over to our credit card, and we'll let you have 0% interest for the first 12 months. And we're going to charge you a 3% fee for the amount of the balance that you transfer over to our company. And then you essentially have 12 months of no interest as long as you can get it all paid off inside of that 12 months. But you have to have a plan and you got to be a little more aggressive. What else have you seen about balance transfers, Zach, or things people should know about?
Well, just to do the math on that real quick, if you're looking at a balance transfer, again, like you said, it's to give you a little bit of breathing room. You know, if you wanted to be the ultra responsible consumer and you wanted to do a balance transfer from a, what is it, 22% average interest rate on credit cards over
Yeah.
to 0%, then you could still make that kind of interest payment to try to get your balance down as quickly as possible in that first 12 months and do some recovery with that, or just kind of enjoy the absence of that accumulating interest, which is, one of the things that kills people, especially with rates as high as they are right now. The thing that I would caution against on balance transfers more than anything from a mortgage guy's perspective, this is not from financial planning, this is not from personal budgeting, all of those things, but from a mortgage guy's perspective, is I would say if you're taking it from credit card A, transferring it over to credit card B, you're going to take a ding for opening up a new credit account. So that you can't help but taking a little bit of a hit on your credit score. It's not going to be a big deal, but it's going to be there. What I would caution against is closing that prior account, especially if it's an older account that's got a lot of depth to it, it's got a lot of age to it, because you could lose massive points by, closing down your oldest, most beloved credit card that has a 14-year history on it, right after you transfer that balance over to the new card. You could lose significant points there, and those take a lot longer to recover than if you just open up a new credit account and you start making payments on it on a regular basis. So that's my big red flag about balance transfers from the mortgage perspective and credit.
Does it require you to close it though?
I
don't think it's
honestly,
a must.
Chad, I've never done that before, so that might be a requirement. I mean, you're speaking with more experience.
Yeah, I've done one, and they don't force you to close it. So now you have the option. You do have the option.
Right.
And if you're someone who, and it's just a personality, doesn't make you a bad person. If it's a personality, a characteristic trait, whatever it is, and it's better if you close it just because you don't want to have the temptation of now you got two cards.
That's
right?
another factor, right?
Yeah. Now you're over here. Because I'll admit, I have been bankrupt before. That was 11 years ago that I filed a Chapter 13. And I will admit that one thing I kind of realized that I wanted as a safety net to get through hard times is I only have one credit card that has debt on it, but I actually have about 4 or 5 credit cards.
Right.
Now, 2 of those are American Express, one for business, one for personal. Another one of those, though, is I have a Visa, one for personal, one for business, because not everyone takes American Express.
Right.
That's why I have it.
Right.
Then I'm also an authorized user for one of my parents on a credit card for them. So the only thing I do like, and now the bad part is it'll cost you an annual fee a lot of times to keep these things open. But the one thing I do like is if things got sideways, you at least have tens of thousands, if not $100,000 sometimes, depending on the limits. And they'll give you some high limits. You basically have a way to live. I am not condoning living on debt. I'm just saying if it comes down to I can't eat versus I have to put some money on this credit card over here, then at least you have an outlet. You have
Sure.
something to rely on. But the balance transfers, again, it doesn't erase the debt. And there is a little bit of a fee, like we talked about, but it gives you a reprieve, because chasing that 22% interest carrot down the road, that's a long road, man. That one takes a while. So you just have to get to the point where you're like, all right, I'm doing everything I can and firing at this debt while it's at 0% interest, so that I can get rid of it and then not add up anymore. All right. Number 2, you want to go refi or HELOC? Those are 2 and 3.
Let's
HELOC.
do HELOC.
All right. All right. You do HELOC then. Let's go.
All right. HELOC acronym. We love some acronyms in the mortgage business. HELOC is a home equity line of credit. So you got to think about this. This is a way to access the equity that you might have in your primary residence, in your home, for you can virtually spend it on anything. And home equity lines of credit oftentimes have a Visa or a MasterCard credit card associated with them. And sometimes you'll even get a checkbook if your bank is old school enough. So a HELOC is basically an available line of credit, and it works exactly like a credit card. You've got a limit. You can charge up against that, pay it down, charge it up, pay it down, charge it up. And they usually give you that flexibility period for maybe 10 or 15 years of the loan. And then they force a repayment back to the bank or the financial institution to pay that down to zero over an amortized loan. So let's say that you had a 30-year term. Well, the first 15 years, you can pay up and or charge up and pay down, charge up and pay down. And then the last 15 years is a repayment period. So that's just it's a second mortgage. Technically, it hangs out there on your primary residence. If you sell or refinance, you got to figure out what you're going to do with that HELOC, because the HELOC at the sale is going to need to be paid off. And if you try to refinance it, it's either going to need to be paid off, or it's going to need to be resubordinated so that it goes into second loan position or second mortgage position to the new refinance, and that can affect your pricing and so forth. But it's a great source of ready money, and it's another one of those things, probably cheaper than the standard. It's much cheaper than the standard credit card.
Yeah,
works the same way, kind of a revolving credit situation where you're paying interest only for that first draw period of 10 or 15 years before you get into the repayment period. So it's relatively cheap availability, very good flexible money, and also money that I kind of prefer to leave alone and keep it as ready money. I don't know. It's mindset, Chad. I can't stand credit card debt, and I use a credit card for everything that I purchase. So I always pay it off at the end of the month. Yeah. And there's always this discipline. Now on the HELOC, in my mind, I could charge things up on the HELOC and say, well, gosh, that interest is really a whole lot cheaper than that credit card. Maybe I'll just let it float for a month. And then you get it. That's where your own planning and your financial responsibility begins to erode and deteriorate. And then suddenly you have a balance that you don't like. But I do love a HELOC, whether you ever feel like you think you're going to need it or not. God, it's nice to have that ready money, because you can literally stroke a check for anything that comes along. You got a great deal on something that you've been waiting for, an RV or a jet ski or a new boat, whatever it is. You can literally stroke a check for it and take super advantage with a predictable interest rate. They're an awesome tool financially.
Yeah, HELOCs are fantastic. And the other great thing is that with HELOCs, people go, you mentioned earlier about refinancing them and the subordination and all that kind of stuff, which, we could dive into on a different episode, or if you have questions about that, just reach out to us.
Technical.
But yeah, very, very technical there. But the other thing with HELOCs is you don't have to refinance them to get the lower rate. So people who have HELOCs right now that are going on prime +1 or prime +1.5 or whatever the case may be. Well, when the Feds lower rates, we tell you all the time, hey, that's not mortgage rates. Okay. That's not mortgage rates. Somebody outside's loving the HELOC conversation. That's not mortgage. That's not mortgage rates. But the Fed rates are in a spot where when the Fed rates drop, then the HELOC rates follow. The HELOC rates are tied to the Fed rate. So while mortgage rates are not dollar for dollar, eighth for eighth tied to mortgage rates or Fed rate mortgage rate correlation, the HELOCs, they actually do drop.
Lockstep, the next day.
Yeah, the very next day. So
Yeah.
when the Feds are, going from 6 down to 5.5 or 5.5 down to 5.25 or down to 4.75 or, when it got all the way down to below 2 and below 1 or whatever the lowest point they were trading at, then you're sitting there looking at it. And that's why your HELOCs are so cheap, or that's why they're so expensive. But the point is, you get a mortgage rate. The only way to get a lower one is to refinance. Well, on a HELOC, you don't have to do that.
Right.
So it's kind of a nice tool as well.
It does float with the market, and the HELOC rates are almost always going to be based on the prime interest rate. So whenever you're watching this video, you can look up the prime interest rate. Just Google prime interest rate Wall Street Journal, and it'll show you your first whatever comes up will show you what the prime interest rate is today, and that's kind of where the HELOC pricing starts. You've got a prime rate, and sometimes a bank will have a special. It's a prime -1, or based on the credit score, prime -1.5. I've seen historically, I haven't seen it lately, but I've seen prime -2 on as a standard rate for HELOCs with a floor. It's ultimately it says, but we can't get under 3% or 4% or whatever it is. And then if you have a more challenged credit score, they start adding a little bit. So it's prime +0.5, or prime +1%, or prime +1.5%. So your credit score is going to help you get a better. They're going to grade you on your credit score, basically, in the HELOC world.
Last one, simple refinance. It's cash out. You take equity from your home. The good is that's going to be the lowest rate option. So you say, well, wait, a balance transfer has 0%. Yes, very true. Balance transfer does have 0%. The problem, though, is that a balance transfer after 12 months will not have 0%. It'll be right back up to 15, 20, 25, 30, whatever it is. But on a rate, or I'm sorry, a cash out refinance of your mortgage, that's going to be lower than a HELOC, lower than a credit card, balance transfer in the long run, all those things. The negatives on that are, one, you're going to be stopped unless you're a veteran VA loan. You're going to be stopped at 80% of the value of your home. So it depends on how much equity you have and whether or not you can do it. Two, it's a longer process. It's not long, just 2 or 3 weeks, but it's not instantaneous like a credit card balance transfer would be. Or HELOCs, I actually am closing one in 3 days. So it's just a couple of weeks longer. The last piece, though, and this is the one that gets a lot of people, is if you got a good rate during COVID, you have to give that up in order to get the equity out of your home. And that's why many have chosen the HELOC path, so that they can just sit there and say, hey, I don't want to touch my 2 or 3% interest rate. I'll just take the higher debt over here at this number at 9, 10, 11, 12, whatever it is on the HELOC, and avoid giving up the 2 or 3. There's pros and cons to all of it, because sometimes you may not qualify for the HELOC. You may have to do the mortgage itself. There may be limits to the HELOC, and so you want to get more money, and that's why you have to do the mortgage. There's a couple of different things. Anything I missed on that?
I think it's always a good idea. A lot of these answers are come under the umbrella of connect with a good loan officer, because we're going to be able to take a look at this. There's another disadvantage here, in that you're stretching, this credit card, this consumer debt, out for the rest of the term of your mortgage. If you do a refinance, and so you're stretching it out. That therefore it's a lot cheaper. The interest rate is a lot cheaper. But when you fold all that in, there's a lot of different strategies. Like it doesn't bother me if somebody's doing a cash out refinance to kind of get through a skinny period, or let's take a great set of great surprises. Surprise pregnancy. We weren't planning on it, but here comes number 3, and that means that we've got all of these bills because we've got these other two with daycare and this and that, and mama's going to have to stay home.
Yeah.
And we got to figure out a way to make that affordable. Well, you look at a cash out refinance to take some of these big monthly payments out and just wrap it all into a mortgage. You might be able to help a family might be able to help themselves really get through a tight spot for all great reasons, great and happy reasons with very little downside. Because coming out of that in 5 or 7 years, they may, number one, be selling the house, or number two, be in a better position to refinance that as mom goes back to work and the kids are in school during regular hours. So you've got to take the financial things, get somebody who knows how to do the math on those, do some solid math, but then fold that into lifestyle, your personality, how adept you are at financial planning long term, kind of your spot in life and what you can see coming down the tracks, and then make a responsible decision, because that same family might be better served to get a HELOC. They might be better served to do a cash out refinance and consolidate all that debt. There's a lot of different ideas. And that could also, let's put a third option in that scenario, Chad. We got a new baby on the way and we need more space. So it might be selling the house, consolidating the debt with some of the proceeds, and buying a new house with a lower down payment. That could be the very best option. So there's lots of life planning things that we do in the mortgage business that may not seem apparent on the surface.
What I tell people is that you never know what's going to happen. Life doesn't ask you what you want to do.
Right.
It just more throws it at you, and you have to adapt and adjust and pivot constantly. I mean, that is life.
Recalculating.
Yeah, it's constant. And so, that's the thing. You just want to have these avenues, these outlets, these ideas. You just want to be knowledgeable. And that's why we share these. Holiday season, that's where a lot of people spend a lot of money. And that's between Black Friday and the end of the year.
Yeah.
And then, of course, we're not even factoring in what Zach just brought up. And that's life events, births, deaths, injury, medical crisis, all these things,
Job
loss, student loans. You decide to do something like that, change careers, not just job loss. You just want to be an entrepreneur. All these things, kind of add up as to different possibilities. So, final thought.
That's all I got, man. That's a big topic there. There's a bit, it just got bigger right there at the end in my mind. But good sources of some short-term solutions to kind of bridge the gap. And we'll talk more about, maybe some other things that can help in the next few episodes.
Yep. And as we approach the end of the year, we want to talk about sometime over the next week or two, homeowners insurance. That's another thing that is, you have a situation with your house and all of a sudden you got a $20,000 repair, and homeowners insurance either won't cover it, or maybe you got a really high deductible. And so trying to figure out how to come up with that money. So again, just more life events, right? So we'll hit on those. We got a few more episodes before the end of the year. Appreciate you hanging out. That is 52, I believe, in the books.
Is that right?
I think that's 1 year.
We ought to have a 1 year anniversary of some sort.
Yeah. Thanks.
Toast you at Starbucks.
That would be more appropriate. Yes. All right. So hit us up on socials: YouTube, Instagram, Facebook, at Zach Jones Loans, at Mortgage Dad Chad. Like, subscribe, follow, DM, hit the bell, share it with someone. I appreciate it. We've had a lot more views recently over the last 2 months.
My channel too.
Yeah. I can't thank you guys enough, because again, it makes it worth it. It really does, to know people either get something from it or, hop on, check it out, whatever the case is. Hope you enjoy them. Thanks for everything. And we'll catch you next week.
See you next time.